Good afternoon, everyone, and welcome back to another Wednesday show. It's 12:15. For the next 30 minutes, we're talking with you, the Orlando homeowner, and today we've got a great show with Mo Khan, who's been a colleague of mine in the industry and now as a mentor in terms of the mobile home space. We're going to talk about that and how he shifted all of his assets and passive real estate into the mobile home area. Stay tuned. It's going to be a great one for you. Mr. Khan, how are you, sir?
Hey, Rick, how you doing?
Good, man. Hey, thanks for jumping on, and I'm glad you're chuckling the intro there. We've got to be official. Hey, we are live on Facebook and on YouTube, so if anyone out there is watching this, we are chatting here with Mo Khan. He's an investor, he's a realtor, he's a businessman, and most recently, you've actually shifted, I counted up about 6 different units from single-family quadplex duplex. He said, I'm going to sell them all, and now you're in the mobile home space. Thanks for joining us today.
You're welcome.
Talk to us a little bit about your quick background. How long ago was it that you started in real estate at all, representing yourself, representing others? Give us that kind of backstory of what brought you here today.
Sure. So I started off in real estate probably going on about 6 years ago, and started off as a realtor, just helping home buyers and sellers purchase homes and sell homes, and started off just doing a bunch of cold calling. Started off my career at Keller Williams and learned how to lead generate. I had moved to Orlando. I didn't really know anyone. I had moved here literally 3 months before I started real estate. So no database, no one to lean on, no one to help me. So I had to learn how to pick up the phone and dial, and that's what I did for the first couple of years.
So 6 years ago is 2015. We are out of the crap storm of real estate, but we weren't sure when the recovery is going to be there, right? Because we've been due for a recession because cyclically they say the market will shift from buyer's market to seller market every 7 years. Well, our bottom was 2010, 2011. And
Yep.
So we are expected to have a shift in around 2017. You got in 2015. How was the market when you got in? Because I think it's extremely impressive. You came here with little to no database and just said, I've got soles in my shoes, a fist that can door knock, and a phone that can ring. How was it getting into real estate in 2015?
It was definitely a buyer's market in 2015, to be honest with you. And
Yeah.
It was easy to work with buyers, easy to put them under contract. There weren't multiple offer situations on most houses. So it was pretty easy. And then starting out as a realtor, you predominantly work with buyers. So I'm happy that I got in at that time. And listings didn't come until years later, after all the buyers I sold came back as listings.
Gotcha.
But yeah, it wasn't bad at all. Getting good deals was easy to do. Sometimes seeing in properties listed on MLS, you can offer 20, 30, 40,000 below list and get the offers accepted, which is a very different case than 2021.
If you are buying a house right now, you are giving him a giant middle finger, because right now, the biggest problem we have with buyers in Orlando is the offer and the contracts that are being accepted are having a hard time appraising, because buyers are writing $15,000, $20,000 above list price, and the appraisals aren't getting there. So it's very interesting as we take, because now you and I are both, you're still representing buyers and sellers. I've got a listing. We turned down a higher offer for the reality of that appraisal and went with the one with the appraisal waiver versus contingency there. So right now, the best offer is not the highest gross if it's grossly too high. But that's not today's conversation. Today's conversation is how you have shifted into investor. Now, in 2015, did you know you got your license to ultimately be an investor, or was this just another job and career move for you to be Mo the realtor?
No, the goal was actually to be an investor and work with investors. And
Okay.
that was always kind of the passion of mine. I like the numbers aspect of it, and finding deals was really exciting. So the first deal I did actually came at month 6, and I ended up buying a duplex. And I got it in Orlando for it was listed at $130,000, and I offered them $100,000, and they accepted the offer. And then I did the inspection and knocked off a little bit more off the price. So I got it for $99,500, and it was actually cash flowing at $1,600 a month in rent. So it was almost like a 16% return.
Wow.
Back in the day, I guess that was common because there was a lot of deals I was looking at that were like basically 16% returns.
Wow. And you held on to that. Is that one of the duplexes you just sold?
Yeah, that was like the last one I sold
Okay.
because I had loved it. It actually almost paid itself off within 5 years, and then I ended up selling it for like $60,000 more than I paid for it. So it was the best deal I probably ever did.
Awesome. Good for you. Well, I recall when I got in licensed, it was end of 2010, so really 2011. Average price point was $97,000. All day long, we were seeing 3-bedroom, 4-bedroom, 2-bath houses right around UCF conservation going for 110,000. And I'm going, hindsight 2020 says just figure out how to raise the capital and go buy it. And now, fast forward 11 years for me, 6 years for you. We're in 2021. Last year, COVID hit.
Mm-hmm.
There is a lot of uncertainty actually around exactly 12 months ago. We are on the 12-month anniversary of when COVID really became real.
Mm-hmm.
The end of March into probably end of May was a very uncertain time for the real estate industry, from are we essential to what's going to happen to the market. And you had shared with me that you believe that although we were 4 years overdue, this was going to be the reason that the market was going to shift. Tell us about your thought process then, a year ago today.
Yeah, so basically, like around March time, you see what happened in the stock market. It just basically completely came down big time. Like I think it was like a 30-40% dip. Some stocks dipped like 60%. I remember seeing Zillow trading at like $30 a share, which was down like almost 70%. So I was a little nervous. I thought the market was going to crash. I was like, time to cash out. So I ended up selling off all my assets, and I was wanting to do that anyways because I wanted to get in the commercial space. I envisioned it like Monopoly, where you get the 4 little greenhouses, and then you want to level up to the big red hotel.
The Red Hotel. Good
Yeah,
for you,
so
man.
that was what the goal was, and then seeing the market shift, starting to shift, the panic set in. So I definitely sold everything that I possibly could, and then we're just sitting cash heavy for opportunities. And I wanted to be in the low income space because I feel like if distress happens, then the low income space will increase because there's going to be more people looking to have cheaper rent. So I felt like the low income space was recession proof. And if the market does shift now or within the next couple of years, I think I'll still be okay.
I love it. So you went in, you weren't weary about leaving residential into commercial because the commercial space you're going to was still going to be working with the residential households, not with businesses, yet with the, well, in this case, mobile home park. So you bought your first mobile home park, I believe it was August, if memory serves, right?
Yeah.
Now, you said the lower income sector, was that either apartments or, multifamilies, or did you know you wanted to go into this mobile home space?
I was actually trying to buy a commercial building in Oviedo, to be honest with you, like a business center. And what happened was all the lenders just basically stopped lending entirely. So the deal wasn't favorable anymore. And our cash on cash return pre-COVID would have been the buy box. It would have been 20% cash on cash return. The investment would have been like a 10% return, like overall. And just because we simply couldn't get a loan with, like, people wanted like 30-40% down. And then they wanted like huge reserves, like a year or 2 reserves in the bank. So it became just kind of crazy. So the mobile home space I was able to get into, found a deal that was actually like a 16% return, which it was harder to find 16% return deals anymore. And I found one, and I didn't have to take a loan on it. And the owner financed it for me at like 4% interest, and gave me the same terms a bank would give me, slightly better actually. So I didn't have to take a loan, and it was COVID, and you couldn't get a loan, so it ended up being the perfect deal for me.
Well, and with not able to get a loan, it takes that buyer pool so much further down. If you weren't able to think outside the box, was that your idea to go seller financing, or was that his?
No, it was our idea, and it was actually a broker involved in the deal, and he got me a great deal. So I'm like, I don't care about using my real estate license. Like, you're double siding this deal because you totally earned this commission.
Yep.
And then he's the one that says, hey, he'd be willing to hold some note. So I did put a substantial down payment down to get the note to be held at what it was, which was 4% interest, 25-year AM. So one of my units covered the entire mortgage, and the rest was like profit. So it ended up being a great deal.
One of your units of the mobile home park that you bought. Tell me about that project. What is that first one? How many lots? How many buildings do you own from that? What sort of revenue and what sort of expenses do you have on that?
Sure. So it's in Tampa, Florida. So it's not too far away. It was 18 units, and it had a lot rent component to it. So it's half RV, half mobile homes. Actually, not really half and half. It's 13 mobile homes and 5 RV lots, and it was pretty much 100% occupied. And the streets were paved. It was a nice looking property, and the cash flow was there to match the money that was being put in. So that was the
Okay.
first deal that I did.
So 18 lots. What did that cost of that? Do you mind saying or sharing what that was?
Sure. So I ended up getting it for like 650,000, and
Okay,
then
so
I put like 400 grand down, and the seller held a note for 250.
okay, so if we take 650,000 divided by 18 units, that's $36,000 a lot. Is that the way to think in terms of, because I know when you do multifamily or apartments, you're looking at cost per door. Tony Wynn, he's been on the show here before. He always says my cost per door is X. Are you looking at cost per lot the same way you look at an apartment complex?
No, so I learned over the several months of analyzing tons of these deals that it's not really it's not about the cap rate. It's not about the numbers. You can go to one park and it could need a ton of work, and it may look good on paper, but it may not be good on paper. And then you might see a park with a much less return, but when you go there, it doesn't really need any work at all. So I would say with the mobile home park space, you have to go check out the property in person, and it really depends. Don't ever buy a mobile home park based on numbers alone.
So what are we looking for when you go and you see a winner versus you see a dud? What is a green light for you when you go check it out?
Okay, so paved roads is one of them. Paved roads versus dirt roads. Banks won't want to lend on anything with dirt road. And the number two would be utilities. So, does it have a wastewater treatment plan? Is it on septic? Is it on well? Is it on public utilities? The ones that are on public utilities are a lot more desirable because it's a lot less maintenance and things going wrong. And if it's public utilities, most likely the county is responsible for it. So if it breaks, you don't have to fix it. They have to fix it. If the only thing you would be responsible for is any plumbing leaks in the park.
Sure.
And then another thing would just be the overall condition of it, whether or not there's been some repairs done to them over the years, or whether or not they're just like dilapidated and falling apart completely. That makes a huge difference. And then the number one factor would be park owned versus lot rent. And that's what I love about the mobile home park space is the whole lot rent component of it. So you can basically just own the ground and collect, $500, $600, $800 a month rent just for a parking lot. So it's basically like owning a parking lot rather than owning a mobile home park. Then the other component is owning the properties themselves, and the returns can be much higher, and the numbers will look a lot more beautiful if you own the property. Like you can get anywhere between like $700 to $1,000 a month for a park owned unit versus a lot rent unit.
Well, let me back up there a little bit because I have some questions because you said lot rent you could get anywhere from 300 to 700 just for the dirt, and you are essentially maintaining the common areas, making sure the utilities are in good working order. But then someone takes their modular home, puts it on there, and they become a pretty much a permanent resident because to move a modular home is 99 times out of 100 more effort than it's worth. Would you agree?
Yep, 100%.
Okay. So then when you say you can get 700 to 1,000, you might get an extra $400 a month for that modular manufactured a mobile home. Yet now you've got maintenance. Now you're taking care of the house. Now you're a landlord when the sink leaks, when the carpet needs to be done, when the new AC is done, if there's a roof leak. To me, I'm kind of with you. I love the let's go rent out the parking lot, and you, Mr. Homeowner, you own the mobile home. This is your thing to maintain, not mine. And talk about long-term. I've got a tenant right now in a single family, and she's on year 7, and I brag about that, of how blessed we are to have someone with that long-term. For you, I mean, for someone to move out of the mobile home, it's got to be the same as homeownership, 7 to 10 years. Are those numbers check out as well?
It depends. So most of my parks are senior parks, and the senior parks will have more longevity. A lot of them are on fixed incomes, or Social Security, disability. And those type of tenants, as long as you maintain the properties for them, they'll be there for a lifetime. I've had some tenants that have been there 15 years, or 20 years, almost probably as much as I've been alive, they've been living in that home.
Yep.
The younger tenants tend to move around a little bit more. You're always going to have your good apples and your bad apples, but I can say overall, like, it's been a great space, and I do own a lot of them myself. And you would think, like, with the whole pandemic and, you know, all the people not paying rent and all the distress in the world, I want to say there's probably like 95% of people that are paying right now, or even 96%, which is actually like normal numbers for a rental portfolio.
Well, it's interesting, and you know, this is a very specific case. My father-in-law lives in a 55 plus modular home community, so it's very fixed, and he's got the crawl space, a 3-bedroom, 2-bath, and he's paying his $400 a month for lot rent.
Mm-hmm.
When we talk about moving, he doesn't say I'm renting the lot. He says this is my home that I own. The psychological is that it's pretty much this is their home, this is where they live, and they will leave feet first. Meanwhile, you're the HOA who collects everything and maintains it. So the title I put for the thumbnail is you went all in on mobile home parks. You didn't get one and then go diversify and go back to your commercial retail space, your office building. You doubled down and then tripled down. You did it all in the past 6 months. Tell me what's happened since August 2020.
So I love the value add components of it. And not every park I bought was like a slam dunk deal when I bought it, but it had some sort of element to it that I was able to increase the value, whether it be like super low rents or whether it was low occupancy and a lot of models need to be rehabbed. And the way I look at it is like all numbers. So if I can take the rent from, let's say, $10,000 a month to $15,000 a month, then I just increased the value of the park like almost 40%, even 50%. So with these 3 parks I purchased last year, I actually built in about $1 million in equity on the property because I was able to increase the value that much on it. So imagine, like, you know, we took over these parks, they were making around $20,000 a month in income. Now they're making $45,000 a month in income. You best believe it, I can sell it for a lot more money than I paid for it.
Well, and that's something interesting we chatted with a little bit with Tony on a previous commercial episode, that when you buy a single family home, the appraisals are very much around the surrounding comps. What is a house like this sold? Very rarely are they looking, if you're an investor buying single family, of going, what's a potential rent? And could you do a value add instead of getting $1,500 a month, get $2,000 a month? They don't really care. They say, what's the size of this house? What are the comps? What are the adjustments? This is what it's worth. In the commercial space, when you can show them, I bought it and it was making $10,000 a month. And now I added value, put in a laundromat, fixed XYZ, put in whatever you put in, and you literally increased your monthly rent by 50%. Is it simple math that your valuation just went up by 50% in terms of appraisal as well?
Not necessarily. So the appraisals will use like income cost approach, which would basically be one of the factors of their appraisal. And then they'll use comparable sales as well and what it has sold in that area. So mobile home parks are a little bit hard to comp because the trailers really have no value. Like, for example, if I bought a brand new trailer and I paid $50,000 for it, it's just like a vehicle. The next year it's worth half, and the next year after that's worth half, and the next year after that's worth half.
Mm-hmm.
It's hard for banks to put value on the trailers itself. So it's hard to finance a lot of park-owned units. Local banks will do it. Big banks won't.
Okay.
However,
and seller financing becomes that alternative.
Exactly.
Yeah.
So a lot of the people that you talk to, they're older folks, and they're just going to know that, hey, they bought it with owner financing. They expect to sell it with owner financing. So it's not uncommon in this space to ask for owner financing. However, the lot rent models are highly financeable, and you'll get amazing rates on those. You know, you can get loans with 3.5%, 4% interest, 25-year M, 5-year balloons, because you're renting the parking lot for the bank. There's virtually no risk. And Fannie Freddie got into the mobile home park space probably like around, I want to say like 6-7 years ago. And it's been proven to be their best performing asset with the lowest delinquency rates out of any sort of asset class there is for these lot rent communities. So they absolutely love it. So you definitely get favorable terms.
And the Fannie and Freddie is the government-backed loans that we often see, and they're going, it's the best. It's the one that has the least amount of risk for them in terms of how it's performing, for least risk of default, is what you're saying, right?
Yeah, 100%.
Now, when we talked, we initially chatted because I've got a camper pull behind trailer, and as I'm looking for places to camp, I thought, what a neat venture to go invest in a campground. And that's where I started getting intrigued with it. And where do you find it? And what is zoning for it? So talk to me a little bit about buying one is one thing, right? I see it, I see what it's got, I see the occupancy rate, I see the income. Another one would be if someone wanted to develop it. They see a plot of land, it's on a nice lake or it has access to something. There's an appeal for either a long-term manufactured home or short-term campground. What goes into that? What kind of zoning and what should people be aware of, or what questions should they be asking?
So I would say like mobile home parks are going to keep going up in value because it's they're not really giving much approvals on it. Counties don't like them. Towns don't like them. Trailer parks have a bad stigma to it for whatever reason. I'm not sure. Maybe some movies back in the day showed that they weren't good places to live. But I can tell you, like all my places, people love it. It's a great place to live for the most part. So getting zoning on it is really, really difficult because of density and future land use. A lot of people don't want them there. And the reason why is because mobile home parks are a depreciating asset, because remember, the homes on them depreciate so quickly that you can get a lot of tax benefits. And the problem is, like my mobile home park, two of them, I pay $6,500 a month in taxes. I'm paying more than that on my one single family home. So how much is that really benefiting the police,
the local municipality,
the education? So people don't want them around for those reasons, or counties don't want them around. So if you can buy one that's already open, that has a zoning grandfathered in, then that's what you definitely want to go with. And then you got to be careful as well, because there's something called conforming and non-conforming. And some mobile home parks or RV parks, if you lose a unit on there, the government or the local municipality won't let you put a new unit back on there. So it'll basically just be like a depreciating asset. So really be careful when you're putting an offer on there. You want to call the county and find that out, because what they want to do is they want to redevelop that land for some sort of commercial, maybe apartment building or an industrial or whatever it is. But they don't like mobile home parks around.
That's a huge nugget to write down, because that could be completely costly. That you'll still own the land, but you've lost your entire passive income. So if we repeat that again, you had a couple nuggets in there. The tax benefits.
So conforming and non-conforming. So basically, if one of them burns down for whatever reason, or let's say it's a tenant-owned home and they remove their home, they remove the mobile home from the space.
Yep.
Then you won't be able to put one back on. A lot of people,
and so it's dead space. You pretty much
dead space,
that is now a garden that you get to have for your residents.
Yeah, exactly. So the county's like kind of squeezing you until it disappears in a way. So the way you can get them is to go in the middle of nowhere. Go to places that have loose restrictions, that aren't heavily populated, that really want something to be there. There are parts of Florida, like Perry, Florida, for example, which is kind of in the middle of nowhere. We've called them developing, and they're like, hey, whatever you want to do.
You went very quiet there. You went very quiet. I don't know what happened to your microphone. There.
Okay, can you hear me?
Yes. Go back to Perry, Florida, and you called them and did something. I don't hear you.
Can you hear me? Hello?
Yes. Stay there. Whatever you just did, stay there.
So some areas of Florida that aren't as populated, they will give you whatever zoning you want. They'll let you build whatever you want. We're actually looking into a project right now in Kingston, New York, which is upstate, and they're actually giving us a grant to build out like a tiny home community. So it really depends on the area. So go to like the countrysides or the more agricultural areas, and you can get something redeveloped there if you really.
What is the zoning we need to be looking for?
So every code is different. So Orlando is called RT1, RT2, and like Lake County, Volusia County, they all have different codes. So it'll be RSC or whatever it is. You just got to look it up online.
Okay. And long-term modular home is the same for a KOA campground. Same zoning.
No. So it's called a special assessment that you need on there. So you have to have the zoning for the density first, and then you have to do a special assessment. So you'll have to appear in front of a board, presenting the plans, and then the county has to approve it. So it's not as simple, the campground ones.
Not just interchangeable, but so it does go around with density, goes around with approval, goes around with how much they can recoup for taxes. The other thing you mentioned is conforming the tax benefits of writing it off. And I want to repeat this because it's important. When you own any real estate, every time you can depreciate, the roof or for the house itself, it becomes a deduction to your income because it's a cost, therefore a deduction in tax liability. So that's why your taxes are saying still low, although the evaluation of the appraisal is still high. With all the depreciation deductions, your tax liability remains low. Did I summarize that?
Yeah, exactly. So depreciation is a huge cost benefit.
Okay. So you have leveraged and gone all in. When I say you've gone all in, not only have you sold 4 single-family homes, a quadruplex, and a duplex, you did it initially by cashing out for thinking, what's going to happen with COVID? You sat on it, and then 4 months later saw this opportunity. You've then gone all in. Do you mind sharing what your portfolio is doing for you now? Because you mentioned in 7 months you've bought 3 that is now setting you up for retirement. What's the potential for somebody, or what have you gained from this?
Yeah, totally. So all the properties I owned before weren't enough income to retire off of, and because it's like, would you rather make 10% of $100,000 or 10% off of $1 million? And that's really what it means for me. So, and then plus the value add component of it. So right now, I have close to 100 units, and I have another 16 under contract, scheduled to close in the next like 6 weeks, and I'm going to keep acquiring because it's like a snowball effect. Once the income keeps coming in, it's easy to keep acquiring. So basically, right now I'm at probably like 45,000 a month in income, and then once I purchase the new park, I'll probably be like $60,000 a month in passive income from the mobile home parks, and that's gross, of course. So operating expenses around 30%. So we usually profit at 70%. And I would say with debt services, you're probably profiting at 50%.
So even 50 once you close here, gross 60,000 a month, net 30,000 a month. That's net profit. That's $360,000 a year, and you've got someone else managing it, someone else landscaping it, someone else doing everything. You are overseeing to make sure that the job is getting done. Yet you are no longer boots on the ground.
No, I manage through a P&L, and I have property managers for every location.
I love it. And you've built your local real estate team to say, yes, we'll still service our past clients and buying and selling it if they want to do this. Yet you've also got a dedicated team that is strictly hunting for the owners' names, for their information, to find these off-market deals. Are you finding more of these mobile home parks are off-market, or are they listed traditionally, or both?
90% of the deals are happening with commercial. 90% of the deals happen and they never hit the market. And there's some sort of allure that most investors don't want to buy on-market deal because they feel like if it's on the market for more than 30 days, it wasn't a deal. So be careful if you're selling these properties. Even like my properties, if I'm selling them, I'm moving them off market. I don't put them on MLS.
Yeah, that's what I heard as well, that it's important that if you are going the commercial space, so much of it is done off market. So make sure you talk with an expert in that space who can find you and help you find that off market. Mo, I mentioned I was interested, and you said, Rick, tell me what, when, where, how big, how much, and your team can essentially find it. That's the resource that I don't have right now. So you are my resource for that. So I appreciate that. And if anybody wants to get into space, how can they connect with you, Mo, that to learn more about you or to just to reach out and say hi? What's the best content? Or
you can share my number right on the chat, and if you guys are on my Facebook, my information is completely public. So call me anytime you want.
What's that number again?
516-244-2157.
Perfect. Let me just scroll this here. So we've got that. And come on, show that. There we go. So there's Mo Khan, 516-244-2157. He is going all in. I don't think you're slowing down. What does the end game look like for you? When you finally say, I'm done, what does your portfolio look like? Do you have any clue?
So we're actually developing right now. We're looking to develop a container home community nationwide, and we want to have 4 per state, and we want to build out like basically a $1 billion tiny home, shipping container home community. That's a lifestyle community that has tons of amenities inside of it. So I want to take the mobile home park space into the 21st century and redesign everything completely and just have a lifestyle community.
Well, the tiny home space, I imagine, becomes a fixed asset. Therefore, it appreciates in value versus depreciates. Better to get financing. Is that true?
Absolutely.
Yep, all that stuff there. So the challenges you have, you go, let's keep the same clientele. However, remove those challenges by making the tiny home community.
Exactly. What are some? I want to solve a couple problems. I want to solve the problem of low-income housing, and I want to solve the problem of, just the generation right now. Everyone is the younger generation is thinking a little bit differently. They want to travel. They don't want to be attached to large items. like a 30-year mortgage on a house. So we want to just kind of change the way things are done a little bit.
I love it. And that's been the biggest shift. We talk about a shift is coming. It hasn't happened moving from sellers to buyers market because we are further in the sellers market than I've seen in my 11 years doing real estate. The shift is the way in which consumers and the need in which consumers are buying real estate these days. So I love what you're doing there. What is some of your go-to resources where you learn and educate? Is it just School of Hard Knocks, or do you have a go-to podcast, book, or seminar that you go to?
Masterminding. So I find people that I want to be just like, and I pick up the phone and call them, and I say, hey, can you teach me everything? And I ask them tons of questions, and I just find the right people to align myself with. So that's helped me big time.
I love it. And here you are paying it forward to us. So thanks, man. I appreciate you. I always learn something new, and I know we've had some great growth. So let's keep it up and have some great future together. Appreciate it, man.
All right, thanks. Take care.
Okay, bye-bye.